This month's question comes from Dave, who owns a small service-based business, and he asks, will I have to pay taxes on the sale of my business? Dave, I shared information about the different types of business assets in my last episode. Now let's talk sales structures.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
Each business sale is negotiated differently, which can affect the taxation on your deal. Maybe you're selling your business on a contract over time where others might require payment up front. How you structure your sale can have a very significant impact on the amount and type of tax you will pay, as well as when you pay your tax. If you're selling your business on an installment agreement over time, then you'll likely recognize the taxation over that same period of time. However, if you have inventory that is part of the business sale, that has to be recognized as ordinary income in the year the sale takes place, even in the case of an installment sale. So what do I mean when I say how you structure your sale? I'm referring to how the purchase price is allocated to the various assets being sold. Let's say Dave is selling his business for $100,000. He and his buyer agree that $4,000 is allocated to tools and the rest of the sale price is allocated to his customer list, an intangible asset created by Dave. Now let's further assume Dave has paid $3,000 for his tools originally, and then he already wrote the full $3,000 off on his taxes. Dave would pay ordinary income tax on $3,000 since that is the amount he depreciated, and he would pay capital gain tax on the remaining $1,000 of the tools plus the additional $96,000 allocated to the intangible asset of the client list. So the total sale price subject to capital gain is $97,000, and the remaining $3,000 will be subject to ordinary income tax. Also, since Dave is paying ordinary income tax on the Section 1245 depreciation recapture, that has to be paid in the year of the sale, even in the case of an installment sale. There are a lot of variables to consider when selling your business, and keep in mind, how your actual business is structured can also affect the taxation of the deal too. For instance, if your business is a sole proprietorship, a partnership, or an LLC, then assets sold are typically treated separately for the purpose of calculating the taxation. However, a corporation, and sometimes LLCs, have the option of selling its assets separately or selling its stock or units of ownership, which has a very different tax repercussion than an asset sale. I'm not referring to a stock sale of a corporation in this video. I'm just talking about the sale of assets to an unrelated buyer. Dave, I hope this information was helpful, and I thank you for your question. If you have a tax question, please submit it to my email address at tina@actservices-inc.com, and I'll make it the topic of a future show. For more information on this and other tax topics, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.